Bitcoin has pulled back from its 2025 all-time highs, and people see this dip as a good time to accumulate more BTC. But what if you could take part of your stack and earn 2 to 8% on that Bitcoin and accumulate faster? Sounds tempting, but many people hear that and they still have thoughts around Celsius, BlockFi, and the FTX blowups. Today, in just a few minutes, I'm going to break down the basics so you can answer the question, should you risk some of your BTC for yield in 2026? If you don't know me, I'm Jacob Brown, the co-founder of BitcoinYield.com. With 6 billion in TVL tracked across 25 or so protocols, we are the #1 place for research and real-time data on where to deploy your BTC to earn yield and the risks involved. Note, this is not financial advice. Yield does come with real risks. Without further ado, let's jump in. There's a few ways, 4 big categories that we see that happening. One is staking, where you lock up your BTC and you might secure a network or just signal intent, and you'll get paid either in Bitcoin or in a different token, which you can then cycle back into Bitcoin. Basis trading is also a very common one. This one typically happens on centralized exchanges, and they arbitrage the difference between the current spot market price and the futures price, and they get profit on that difference. Third is providing liquidity and routing payments, and these kind of fall into 2 sub buckets. On Lightning, providing liquidity is you putting it into channels to be used for routing payments, or if you're actually routing those payments, you can take a small fee for facilitating that payment. Also, you'll see this in the DeFi space where you can provide liquidity into a DeFi protocol and you can make some benefit in that way. And there's many, many ways that providing liquidity happens in the DeFi space. And then fourth is lending, which isn't as common in the on-chain space. The returns are pretty low, but in the more institutional side, this can be a decent way with minimal risk to earn a yield on your Bitcoin. And then kind of an umbrella term that's happening for a lot of these is vaults, which is these are specially constructed kind of like black boxes of deploying your BTC into the smart contract, and it has specific ways it can be used. And so what people are doing right now is making the input flow easy, and then you can abstract away what's happening on the back end. So increasingly, vaults are a way that you'll see people do a bunch of stuff on the back end. It could be any one of the 4 things I just mentioned, and it's happening through a vault interface. So I want you to be aware of that term as we go forward. So from those categories, what is the expected yield you can get from some of these? And depending on the product you're using and the current market conditions, we're seeing from 1% to 7 or 8% is the sweet spot today. It's important to note, though, that every yield option comes with trade-offs and risks. The most common ones are custodian risk, where you give your Bitcoin to an entity and you trust them to be responsible with it. Counterparty risk, so does the platform go down while they're holding that Bitcoin? This could also be a protocol. Smart contract risk, if you're doing something on-chain, where you deploy Bitcoin into a smart contract and maybe that protocol gets hacked. If you're doing some kind of leverage strategy, then liquidation would also be a potential risk for you. And opportunity cost is also a factor, where depending on what you're doing and what strategy is being deployed, some of them will get you in and out of different assets. And so if the price rockets up, you might not see as much of the benefit depending on your strategy. Each one of these has a huge design space of trying to mitigate the risks or increase the utility to make them more functional. And it's important to just look at them piece by piece and product by product to understand what you're looking at. Which leads into the question we started with. How do you decide for yourself if you should put up your BTC for yield? A good starting place is to ask yourself these 3 questions. 1, do I understand the product I'm deploying into? It's good to research anything. BitcoinYield.com is a great resource for this, to understand the security concerns, how is the yield generated, and if you start to grok it, you can make a decision for yourself. Second, how much am I willing to risk? This depends on you. If you want to go YOLO and try to accumulate as fast as possible, you might go up above 20, 30, 40%. And if you're much more conservative, you want to try out different protocols, it's much more common to do something, a few percentage of your stack and just try these things out. And when you wrap these together, you need to ask yourself, what is your true risk tolerance? Only you can answer that, and if the risks and trade-offs are worth it. For many pure hodlers, the answer is still no. You can see that in the on-chain data where most BTC is still sitting on the L1, but that number is increasing pretty rapidly over time. If you're actively accumulating right now, besides just buy and hodl, a lot of people are buying small positions to try these things out, and then as they build trust in those protocols over time, they might upsize their positions. We're curious where you sit. If this helped you think clear on this topic, like the video, subscribe to the Bitcoin Yield newsletter, and read BitcoinYield.com to understand how these protocols work and how to safely earn yield on your BTC. Until the next video, always be stacking and accumulating.